Hi, I'm Adrian. Welcome back to Premium Logic Lab. If you watched the market on Thursday's open, you felt it. SPY dropped hard, Bitcoin dropped hard, and then it kept going, like dominoes. When moves look like that, people usually say one of two things. Either, something terrible happened, or, this is manipulation. But most cascades don't need a single dramatic cause. They happen because the market is a system, and once certain levels break, the system starts feeding on itself. Today I want to explain how that self-fulfilling spiral works, why it feels unstoppable once it begins, and what factors usually cause it to slow down or stop. This is not a prediction video. It's a mechanism video, because when you understand the mechanism, you stop being surprised by the speed. 1. The first idea. Price moves don't need belief, they need flows. A lot of people assume markets move based on opinion, but the biggest moves often come from flows. When positioning is crowded, leveraged, or one-sided, markets become fragile. At that point, price doesn't move because people changed their mind. Price moves because participants are forced to change their position. That's the foundation of a cascade. 2. The cascade starts with a trigger, but it's not the trigger that matters. Yes, there is usually a trigger. It could be a macro headline, a data print, an earnings shock, a geopolitical event, or simply an overnight gap that breaks a key level. But that's not what creates the domino effect. The domino effect is created by what happens after the trigger, the forced reactions. 3. The spiral, the 5 layers of forced selling. When a sell-off cascades, it usually hits these layers in sequence. Layer 1. Stop losses and technical levels. Markets are full of levels that many people watch. Support breaks, and stops are triggered. That's not emotion, it's automation. When enough stops trigger at once, liquidity thins out and price gaps lower. Layer 2. Margin and leverage. In both equities and crypto, leverage amplifies everything. As price falls, collateral shrinks. Traders get margin calls, and when they can't post collateral fast enough, positions are reduced or liquidated. This is especially brutal in crypto because liquidations can happen quickly and mechanically. At that point, price is not finding fair value, it's finding the price that clears leverage. Layer 3. Volatility expands, and systematic funds de risk. This is a big one that many people miss. When volatility rises, some systematic strategies reduce risk by design. Volatility targeting funds. Risk parity. Some trend systems. They don't care about narratives. They care about volatility and correlation. Higher volatility forces them to sell. So volatility rises, right pointing arrow, they sell, right pointing arrow, volatility rises again. That's a feedback loop. Layer 4. Options hedging and gamma effects. If the market is positioned in a way where dealers are short gamma, a drop can accelerate. Here's the simplified idea. As price falls, some hedging flows require selling more into weakness. That selling pushes price lower, which triggers more hedging. This is another feedback loop. Not always present, but when it is, it makes sell-offs feel like gravity increased. Layer 5. Psychology and capitulation. Only after the mechanical layers do you see true emotional capitulation. This is when people say, "Get me out at any price." The important point is this. Psychology amplifies the move, but it's usually not the first cause. The first cause is structure. 4. Why it becomes self-fulfilling. Now put those layers together. A level breaks. Stops trigger. Leverage is forced out. Volatility rises. Systematic selling kicks in. Options hedging adds pressure. And then psychology arrives late and panics into the move. Each step creates the conditions for the next. That's why cascades feel unstoppable. Because selling creates more reasons to sell. Not because everyone suddenly agrees the world is ending, but because the system's risk controls and constraints force synchronized behavior. 5. So what makes it slow down or stop? This is the key question. And the answer is, cascades stop when the forced sellers are finished, or when a new buyer shows up with real size and patience. There are a few common breaks that slow the spiral. Break 1. Liquidations exhaust in crypto. Cascades often slow after a large liquidation wave is complete. When leverage has been flushed, the pressure to sell mechanically decreases. Not because sentiment improved, because the forced selling finished. Break 2. Volatility stops rising. When volatility stops expanding, systematic selling slows. If volatility stabilizes, those systems stop reducing risk. Sometimes this happens because the market finds a level where buyers absorb supply. Break 3. A strong demand zone with real liquidity. Cascades often pause at areas where long-term holders tend to buy, previous consolidation occurred, or the market is clearly cheap enough for patient capital. This doesn't guarantee a bottom, but it often creates a pause, a bounce, or a consolidation. Break 4. Policy or macro relief. In some cases, what stops the move is external. A central bank signal, a policy announcement, or simply clarity on a macro risk that was uncertain. This doesn't fix everything, but it can reduce uncertainty, which reduces volatility, which reduces forced selling. Break 5. Dealers flip from negative to positive gamma if the options positioning changes, so hedging flows become stabilizing rather than destabilizing. The market becomes less slippery. You may still drift lower, but you often lose that waterfall feel. 6. The practical takeaway. Don't confuse speed with truth. Here's the most important point. A cascading sell-off does not automatically mean fundamentals suddenly collapsed. It means the system hit constraints, leverage limits, volatility limits, liquidity limits. That's why the move can be violent. And this is why in moments like Thursday, the best skill is not prediction. It's emotional control, because the spiral makes people do the worst things. Selling after the forced selling already happened, increasing size to win it back, or trying to catch a falling knife without a plan. This channel is about avoiding those mistakes. Understanding how cascades work gives you something valuable. You stop taking the market personally. You stop needing a perfect explanation. And you start thinking in scenarios. 7. What to watch next. If you want to interpret whether the cascade is likely to continue, watch 3 things. Are liquidations still accelerating, or slowing? Is volatility still expanding, or stabilizing? Is there evidence of real buying, not a bounce, but absorption? When those shift, cascades lose power. Until then, the system tends to stay one-directional. If you found this useful, stay with the channel, because in the next video, I'll connect this directly to risk management. How to size positions so that market cascades don't force you into emotional decisions. Thanks for being here.